This book explores the application of intermarket analysis to the foreign exchange market, the world's largest and most widely traded financial market. Intermarket analysis helps traders identify and anticipate changes in trend direction and prices due to influences of other related markets, as financial markets have become interconnected and interdependent in today's global economy. These markets include Forex futures and options, as well as major cash Forex pairs, which are affected not only by other currencies but by related markets such as the S&P 500 index, gold, crude oil, and interest rates. As the world economy of the 21st century continues to grow and as new advances in information technologies continue to be introduced, financial markets will become even more globalized and sophisticated than they are today, increasing the central role that the Forex markets play in the global economy. Since its introduction in the 1980s, intermarket analysis has become a critical facet of the overall field of technical analysis because it empowers individual traders to make more effective trading decisions based upon the linkages between related financial markets. By incorporating intermarket analysis into trading plans and strategies instead of limiting the scope of analysis to each individual market, traders can make these relationships and interconnections between markets work for instead of against them. Forex markets are especially good candidates for intermarket analysis because of the key role of the U.S. dollar in most major currency pairs, while other currencies tend to move in concert against the dollar. What influences one currency often influences many other currencies, usually not in lockstep but to a greater or lesser degree, depending on the circumstance. Knowing what is occurring in various currencies and other related markets can provide traders with both a broader perspective and greater insight into Forex market dynamics. It can
Trade secrets. 24. Changes that were starting to occur in the global financial markets. Due to advances in both computing and telecommunications technologies, coupled with the emerging global economy, made multi-market analysis absolutely necessary. I realized that the globalization of the world's financial markets would mean that the scope of technical analysis and its application through the use of trading software to the financial markets would need to change drastically. As a result, I embarked on my next maniacal mission, which would result in the development of intermarket analysis software. In that pursuit, the scope of technical analysis had to expand to include not just a single market analysis approach, where I had focused my attention previously, but also an analysis of how related markets actually affect each other and, more importantly, how this information can be applied by traders to their advantage. My goal was to examine the linkages between related global financial markets so that they could be quantified and used to forecast market trends and make more effective and timely trading decisions. In 1986 I developed my second trading software program, which focused on these market interdependencies. The program, simply named Trader, used a spreadsheet format to correlate the likely trend direction of a target market with those of related markets, as well as with expectations regarding fundamental economic indicators affecting the target market. This trading software program, albeit quite primitive by today's standards, was the first commercial program available to traders in